Okay, so last class we discussed some basics about futures, such as how do you calculate the profit from your futures long or short positions, and then we also talk about how trading futures actually works. So today let's talk about a more advanced topic, which is about how to price futures. So first we will talk about the spot futures parity theorem. It's essentially about so this theorem is about how futures price and spot price are related. So we will use two approaches to understand this spot futures parity theorem. The first one is hedging approach. Well, you guys have seen this, right? So basically you will want to build a hedging portfolio. And then this hedging portfolio will give you a constant payoff no matter what happens. So basically you could use this this constant payoff, right? And then calculate the present value of your portfolio, which will give you the price. And then the cost of carry approach. This is a new approach. It's a specific approach used in futures modeling. And it's actually a pretty important idea. And later you will see that the idea of the cost of carry model is you will compare two approaches to get your commodity. Right? So basically you can buy it today and store it until the future. Or you could buy this commodity in the future. And these same approaches should give you the same payoff. So the cost of carry approach is based on this idea. Obviously now I'm talking about these two models and they look quite confusing. Right? So now let's officially dig into these models and hopefully you will get a better idea on these models. Okay, so the purpose is to understand the spot futures parity theorem. And now we will use the first approach, which is the hedging approach. So as I said, the idea is about you want to build a hedging portfolio. So how do you build a hedging portfolio? Well, one thing we know that from the previous lecture is to build a hedging portfolio using futures, you can take a long position in asset and you can take a short position in futures. Right? So this is essentially called short hedge. So the idea is, let's say I'm a farmer, right? I grow canola in Winnipeg and I want to sell canola in the next year. But I don't know what is the possible price in the future. So I could take a position. That is, I will short in the canola futures contract. And let's say I have a future price of $1,000 per ton. And then in the future, in the next year, I can sell my canola in my storage unit for $1,000, right? And so if you have this portfolio with a long position in the commodity and a short position in the futures, then if your hedging is perfect, clearly by the definition of hedging, your portfolio will have no risk, right? The same thing, if you recall this canola futures example, if you're the farmer, you would know that in the next year, you can definitely sell your canola in your storage unit for $1,000. So there is no risk. Now, what's the implication of this? The implication of this is the hedge portfolio's return has to be the same as the risk-free rate. So this is the key here. Again, the reason is because your portfolio is hedged and it has no risk. So its return has to be the same as the risk-free rate. Okay, now let's see this example. This is a very simple example, but through this example, you will understand how could we actually use this hedging portfolio to find out the spot future parity theorem. So let's say you're a investor and you invest $1,000 in SP 500. And then we assume at the end of the year, you will get a dividend of $20. So this is basically your long position, right? And let's say there's a futures contract and its delivery date is in 1 year. And the futures price for this contract is $1,010. And now you will build your hedging portfolio, right? So you will take a long position in this equity, SP 500. And then you will take a short position in this futures. That is, you will sell this futures contract. Remember that when you're a seller or you're taking a short position in the futures contract, you will have this obligation to deliver this underlying commodity on this delivery date. So here, let's examine what is this investor's final payoff at the end of the year. Well, this is actually really simple, right? If you just look at this, you will know that, well, since this investor has entered the short side of the futures contract, so in 1 year, he would definitely be able to sell this SP 500 at 1010, right? And then this SP 500 portfolio would pay a dividend of $20. So this implies that at the end of the year, the value of this portfolio would be exactly 1,030, right? And let's see how exactly this will work. So you can see that through this table, we are thinking about different scenarios. So let's say we are examining what would happen if the value of your equity position, right, will be 970. Well, you can see that if your equity position has a value of 970, then you can see that because you have the short position in the futures, then your payoff would be the initial futures price minus the final equity price. Right? So here you will have a $40 profit. And obviously you will always receive this $20 dividend because you're having a long position in this equity portfolio. So you will add up these three parts, right? The value in your equity position, the value from your short position in the futures contract, and the final date dividend payoff. So adding up these three numbers, you will get $1,030. Obviously, you could examine the other case. Let's say your equity position increased to 1,070. Right? So in this case, you can see that because you're taking a short position in this futures contract, you will lose money, right? Because the formula to calculating short positions profit on this maturity date is futures price minus the spot price on this delivery date, right? So you can see that it is 1010 minus 1017. So you will lose $60. Again, $20 dividend. So add up these three numbers together, you will have the same number, $1,030. So this basically means that in the end, no matter what happens, you will have a constant payoff of $1,030, right? So what is your payoff? Let's say if you have this timeline, this is the beginning of the year, and 1 refers to the end of the year. So in the beginning of the year, you have $1,000, and after 1 year, your portfolio would increase to $1,030. Now the key here is this $130 is constant. So let me write down this constant here, because this is the key, right? Because you're building a hedging portfolio, so you will have this constant $1,030. So this implies that in the end, well, because you're having this constant payoff, then you can see that your return from your hedging portfolio would be the difference in value divided by the initial value, which is 3%. Now, this 3% has to be the same as the risk-free rate, because this $1,030 is risk-free. It's a fixed number no matter what happens. So you will for sure get this 3% with your hedging portfolio. So this 3% is risk-free. That is, risk-free rate is 3%. So this is the key to understand the hedging approach to derive the spot futures parity theorem. Now we could generalize this result, right? So let's say again, we have this timeline here, right? So on day 0, you enter this position, and you would actually, okay, let me draw this timeline here, right? So on this day 0, right, you will buy this equity position, and let's say the current stock price is S0, and then you will also enter into the short side of this futures contract. So let's say this F0 is the current futures price, and then you will see what is your portfolio's payoff at the end of the year, right? So you can see that at the end of the period, the equity position, right, the equity position will give you a payoff of D, because you will always get this dividend, right? And let's say on the final day, the stock price is ST, right? Now, what is your futures payoff? Well, your futures payoff is F0 minus ST, right? So again, you can see that we have these 3 components. ST is the payoff at the end of the period of your equity position, and D is the dividend you will always receive, and F0 minus ST is the futures position's profit. So if you add up these 3 components, right, what you can see here is ST would just cancel out. So on the final day, your portfolio's value would be F0 plus D. So you can see that at the end of the period, your portfolio's value is independent of the share price on that day, right? So you actually have removed any uncertainty from your portfolio by using this hedging approach. Then again, this means if you have a fixed payoff of F0 plus T in the future, then this implies the position's return has to be the same as the risk-free rate, right? So now we will get this formula, and clearly you can manipulate this formula, right? So basically, this formula implies F0 plus D minus S0 equals S0 times RF. Right? So this would solve F0 equals S0, 1 plus RF minus D. Right? So you get this formula here. And now, this basically tells you what is the relation between the current future price and the current spot price. And we could further simplify this formula. So if we denote D as, if we denote lowercase d, right, which is equal to the capital D divided by today's stock price. And then we could further write the spot futures parity theorem as this. Right? As this. So what is this lowercase d here? Well, you can see that this capital D is the dividend at the end of the period or at the end of the year. S0 is today. Okay, let's not use today. Let me use current. The current stock price. Right. So you can see that D is actually the dividend yield. Remember that the definition of dividend yield is dividend divided by stock price. To be more precise, you can see that we have some timing difference here. The capital D is dividend of the future or from the future. The stock price is today's stock price. So to be more precise, this is a forward dividend yield. That is expected future dividend divided by today's share price. So now you can see that the idea of this formula is pretty simple, right? So it basically says that if you tell me today's stock price, and if you tell me risk-free rate, and this stock's forward or the future dividend yield, then I can tell you what is today's futures price. So this is a pricing formula. It prices futures price. It tells you how current futures price should be determined. Okay, now let's see an example here. So you might be able to guess this, right? If this spot futures parity result is violated, then we could possibly earn some arbitrage profit. For example, if the futures price is too high, right? That is if F0 larger than S0 times 1 plus RF minus D, right? So if futures price is too high, then we should short the futures and we will buy the equity by borrowing money at the risk-free rate. This is very natural, right? So if equity price is too high, if futures price is too high, this essentially means the futures is overvalued, right? So you should short sell it. And relatively, the equity is undervalued, so you should take a long position. Right? And then if the futures price is too low, that is, if this happens, so in this case, you will long the futures because essentially this implies that the futures are undervalued, so you should take a long position. And then relatively, equity now is overvalued, so you should short this equity position, and then you would invest the proceeds from short sale at the risk-free rate. So let's see this example here. Now let's say we suppose the risk-free rate were only 1% in the previous example. Is parity theorem violated? So let's see the previous example. Okay, so what kind of numbers do we have here? Okay, now you can see that we have these numbers. So we have the contract price and the equity price and the dividend, right? So we now could verify whether F0 equals S0, 1 plus RF minus D actually works. So let's see what is the value of the right hand side, right? So the right hand side is the stock price times 1 plus 1% minus D. D is 20 divided by 1,000. So this would actually give us, okay, let me copy the answer here. 990. So it's 990. So it's 990. And then what is F0? Well, it's today's futures price. So it's just 1,010. Now you can see that essentially the right hand side is larger than the essentially the the left hand side is larger than the right hand side. So basically you can see that the spot futures parity theorem is violated, right? Now, how could you earn a arbitrage profit from this result? Well, you can see that obviously because futures price is overvalued. So what you would do is you will take a short position, right? You will take a short position in this futures contract, and then you will take a long position in this equity. And how do you take the long position? Well, you need some money to buy this SP 500. So you will actually borrow some money, right? So you will borrow some money to take the long position in the equity. Now let's see what you can earn from arbitrage. So let's see. Okay, so as I said, you will short the futures contract and buy this stock portfolio using the money borrowed at 1% interest rate. So now let's see what is your payoff. Okay, we have your cash flow in this or on this initial date, and then your cash flow at the end of the year. So first, you will enter short futures position. Remember that when you're entering a futures position, you're just signing a contract. You're not purchasing anything. So both the short side and long side will not pay anything. So the initial cash flow here is just 0. And then you will buy this SP 500 index. Its price is $1,000 today. So now you will incur this cash outflow. And then to buy this stock index, you would actually want to borrow money, right? So you would get this positive $1,000, the cash you borrowed from a bank. And then next, in the next at the end of the year, you will have to repay this debt. So what happened is you will repay the $1,000 times 1 plus the interest rate. So you will repay this amount. Now let's assume the price of your equity position is ST at the end of the first year. At the end of the year. Then you can see that your equity position will give you this value of ST plus dividend, right? And then what is the payoff from your short position? Well, it's always the initial futures price 1010 minus this equity price on this delivery date, so minus ST. Now, if you add up all these three components, so you will ultimately get $20. Right? Obviously, it's a very simple calculation, right? You can see that these will just cancel out, and ST will just cancel out. So in the end, you get $20. And you could also see that you will get a general way to understand what kind of arbitrage profit you will get, right? So basically, you can see that if you buy this equity for S0, you will incur this S0 outflow, and then you will borrow S0, so this cash inflow, and then at the end of the year, then you have to return this, and of course the interest rate we assume is RF, and then this equity position will give you a value of ST, which is the equity positions of value at the end of the year, and then you will also get the dividend of D dollars, and last you will have this profit from the short futures position, which is this futures price minus ST. So in the end, your profit would be F0 minus S0, 1 plus RF plus D, right? Well, you can see that this basically means that if this spot futures parities theorem is violated, then let's say if this is larger than 0, then it basically means that building a hedge portfolio like this, you earn a positive profit, right? Okay, now let's think about the second way to understand this spot futures parity theorem. So it's called the cost of carry model. It's actually a very widely used methodology in futures pricing, and it's actually quite interesting, and I think it's a very nice way to think how you should price futures. Okay, so let's see how this cost of carry model works. So the basic idea of the cost of carry model is you have two ways to get this commodity, and these two ways should be the same. So what are two ways I am talking about? Well, you can buy the commodity at the futures price at the delivery date, or you could buy this commodity now, and you will carry this commodity into the future, right? So if I draw this timeline here, let's say you want to buy let's say what do you want to buy here? Let's say you want to buy SP 500 index, right? So let's say you want to buy SP 500 index fund, right? It's a mutual fund. Now you have two ways to get it in the future, right? You could buy it today, right? And then you will hold this index fund, and you will hold this index fund into the future, right? Or you could just take a long position in SP 500 futures, right? And you will wait, and on this delivery date, you will buy this SP 500. of course, at futures price. So these two approaches should give you the same payoff, right? So based on this idea, we could find out how to derive this spot futures parity theorem. Okay, now let's see how this process works. So first, let's say the futures price is S0, right? So it means, okay, now let me use a different color. So it means on this delivery date, right, if you have entered a long position in this SP 500 futures contract, you will pay, oh boy, I have nowhere to write down this pay. Okay, you will pay F$0, right, to buy this SP 500 index. You know what? Let me add F0 here. So this means on this delivery date, you will buy this SP 500 at futures price F0. So this is basically the first approach, or we could call it the futures approach, right? Second, you can buy this SP 500 today, and you will hold the SP 500 in your account and wait 1 year, right? At the end of the year, then you should get the same value. However, what you can see here is if you buy this SP 500 if you buy this SP 500 index fund today, you will incur some cost. To be more specific, let's say the SP 500 today's price is S0, right? Now you can see that in this case, if you use S$0 to buy this SP 500, it means that you have tied your cash into this SP 500 equity position. So you have to forego interest payment, right? So you can see that you will have to forego an interest payment of S0 times RF. That is, the interest payment you could earn if you did not put this money into this equity position, right? So this is the additional cost. And you have some additional benefit too, because if you have this, or if you bought SP 500 today, let's say at the end of the year, you will get a dividend payment, right? So this dividend payment essentially reduces the cost of your equity position, because dividend is positive cash flow. It's a benefit, right? So in this case, you can see that the cost will be reduced by D. And you can see that these two methods, right? These two methods of obtaining your SP 500 should cost the same, right? So you can see that this F0 is the cost of obtaining SP 500 using futures. And this right-hand side is the cost of buying SP 500 today and holding it in your account, wait for 1 year. Right? These two approaches, in the end, will both give you SP 500. So they should cost the same. So now you can see that we arrived at the same result. That is, we obtained this same formula using this cost of carry approach, right? What about multiple periods? Right? Well, you can see that for one period, we have this relationship. That is, F0 equals S0 times 1 plus RF minus D, right? And then we could think about this multiple periods. Let's say if we have a total of T periods, right? So if one period or 1 year, the spot parity theorem is given by this, then you can see that for 2 years, you should put a squared here, right? For T year or T periods, you could put a T here. So obviously you can see that what is RF? So RF is really per period interest rate. Now what is D? D is the per period dividend yield, right? Essentially, you can see that in some sense, this is like the cost of carry, right? Because think about it. If you buy this SP 500 today, you carry it for 1 year, and you have to incur this cost because you have to forego this interest payment. However, you will get some compensation, right? You will get this dividend payment. So this compensation will reduce the cost of carry. So that's why this is called this cost of carry model. Okay, what you can see here is now we will get some very interesting result. If you think the relative magnitude of F0 versus S0, you will easily see that, right? If the risk-free rate is larger than D, that is, if the interest rate is larger than the dividend yield, then it means that longer maturity futures prices will be higher, right? Because if RF is larger than D, this guy is larger than 0, and then this guy is larger than 1. So it basically means that if you have longer date, right, then this longer dated futures will have higher price. Now, what about the opposite? Well, it's obvious. If risk-free rate is smaller than D, then longer maturity futures price will be lower, right? So if you look at today's SP 500 futures, then you will observe the second result. The reason is because today interest rate is almost 0, right? So due to COVID, right, central banks have reduced interest almost to 0. I don't have the number on the dividend yield, but for SP 500, I would guess the dividend yield should be around 3%. So you can see that in this case, the longer maturity future prices will be lower, and it will be lower than this today's equity price, right? So, So I can show you that this actually holds empirically. So if you look at today's SP 500, so it has a value of, I cannot draw this, but you can see that, I cannot draw on this. Okay, so basically you can see that this SP 500, right, has a value of 3310. So it's 3,310. Now, if you look at the futures, so you can see that E-mini futures, it has a value of 3273, right? So what you can see here is, by the way, this is December 20th. Yes, this is December 20th. No, it's not. Sorry. This is a December futures. So for this futures, you can see that its future price is about, 40, right? So the difference is 3310 versus 3272, right? So it's about a 40 difference. So you can see that this December futures price is lower than today's equity price. And if you look at different futures, so let's go to CME's website. Let me refresh this. Can I refresh this? So if you refresh this, now what you can see here is you're having different futures based on this SP 500. You can see that December 2020, right? Its price is 3272. March 2021, you get 3260. And June 2021, you have 3249. And September 2021, you have 3232. So what you observe here is as you move to the future, right? Longer dated futures, we will have lower prices. Right? So you can see that this is a useful formula which could explain the real world how future pricing actually works. Okay. Now let me make two comments. So you can see that in this spot futures parity relationship, you have this D here, right? So this is called dividend yield. And you know that dividend yield is really specific to equity. If you're having a bond, hey, you don't have dividend yield. And if you're having a commodity futures, you don't have a dividend yield, right? So you can see that for commodities, such as gold, right? So for a futures on assets like gold, it does not pay dividend, right? So in this case, you can see that if we are dealing with a gold futures, we should set D equals 0. And then you could also see that if D equals 0, we will get this formula. Now you can see that, okay, let me use a different color. You can see that 1 plus our F is always larger than 0, right? So this, sorry, I should not say larger than 0 because in a certain European countries, risk-free rate, I think it's actually is actually negative. But generally, most of the cases, right, 1 plus RF is positive. So this basically means that the gold futures price will be higher if its maturity increases. Now, for bond contract, you could just let the coupon income, right, on the bond as the dividend payment. So basically, this D in this parity theorem will become the coupon payment divided by bond price. And now you can see this empirical result on gold futures. We just mentioned, in the case of gold futures, because gold does not pay dividend. So according to this parity theorem, longer dated gold futures should have higher price. So now let's see this. Let me mark these 3 lines. So according to the graph legend, this line would be August 2017 maturity. This dark line would be February 2017. This one would be August 2016. So you can see that the top line has the longest maturity, right? The bottom line has the lowest maturity. So this basically means that if you compare these three lines, right? Let's say if you look at these lines on a certain date, you can see that the futures with a longer or further delivery date will have a higher futures price, right? Okay, now let's talk about spread pricing. Spread pricing. So this basically talks about the relationship among futures price for future contracts of different maturity dates. I have to mention that sometimes we use maturity dates, but the best word or the more accurate word should be different delivery dates. But sometimes we just borrow terminologies from the bond world, so we use maturity date here. So the spread pricing is actually very simple. It's basically based on this spot futures parity theorem. So let's see how this works. You will see that this is very, very simple. So let's say we have two futures, right? They have different delivery dates. So one is T1, one is T2. Now, according to our spot futures parity theorem, we could price these two contracts according to our theorem, right? And then based on this, it's very easy for you to get this this pricing formula. What you need to do is you will divide the first formula by the second. Right? What you do is like something like this. Right? If you divide the first formula by the second formula, you can see that this S0 will be canceled out with each other, and then this right hand side would become RF minus D, and then T1 minus T2, right? So you will ultimately get this result. This relationship basically tells you that if we have different contracts and their delivery dates are different, how we should relate their prices, right? And you can see that we're getting some sort of the similar results as we got in this spot futures theorem, right? If you look at this, it basically says that it basically says that if T2 is larger than T1, and if our F is larger than D, then FT2 is larger than FT1, right? Oops. Obviously, mathematically, this is pretty easy to see because if T2 is larger than T1, then this guy is larger than 0. And then if RF is larger than D, then this guy is larger than 1. Right? So you will see that FT2 should be larger than FT1. This basically says that if risk-free rate is larger than the dividend yield, then a longer dated futures should have a higher futures price. Right? So it's exactly the same result we got here. Right? This is natural because this so-called spread pricing formula is completely based on this parity theorem. Okay, now let's look at this example here. So let's say we have two contracts, right? So they have different maturity. So this one matures in January. The second one matures in March. And then we have their futures price. Let's assume the interest rate is 1% and dividend yield is 2%. So according to the spread pricing model, is there any arbitrage opportunities? Right? So basically we want to see whether these prices will actually fit into our pricing model. According to our pricing model, right, FT2 equals FT1 times 1 minus RF minus D, T2 minus T1. Now, what is T2? Well, T2 here is March, right? And January here is T1. So obviously, this is FT1, this is FT2. And then this 1% is annual rate. So now let's examine whether the pricing formula actually holds. So FT2 is 105, right? So sorry, I should not use equality sign here. So FT2 is actually 104.75. FT1 is 105. 1 plus 1 minus 2%. Now, what is T2 minus? What is T2 minus T1? It seems that we should put a number 2 here, right? But it's not, because 1% and 2%, they are referring to annual rate. So we cannot use monthly rate. Sorry, we cannot use 2 months here. So we have to use 2 divided by 12, right? It's sort of like you're annualizing so it's sort of like you're annualizing 2 months. And then the right hand side would be given by, so let me check the lecture note. So it would be given by 10482. So you can see that the left hand side is actually smaller compared with the right hand side. So whenever this pricing formula is violated, then you will have this arbitrage opportunity. So generally you will want to short sell overvalued side and take the long side in this undervalued asset. And you can see that this guy is overvalued, right? And this guy is undervalued. So this means you should take a short position in this overvalued futures and take a long position. So basically you will want to take a short position in, let me see which contract. You should take a short position in this contract, and you will take a long position in this contract. Okay, now we talk about it's not a pricing form. We basically talked about the pricing model, right? So the purpose is we wanted to understand how today's futures price is related to today's spot price, right? I mean, this whole section, right? This whole section here, right? These pages, they're basically talking about this guy and this guy, right? So this is the current futures price. This is the current spot price. We want to understand how these two guys are related. And then our result is we have this spot futures parity theorem. So this is spot, right? This is futures, and this is parity, and this is theorem. And now we want to understand a different topic. We want to understand how F0 is related to the expected spot price in the future, right? So let me make this difference more obvious. So previously, we tried to understand these two guys on the same date, on day 0. That is current futures price and current spot price. Now we want to understand a different topic. We want to understand this guy and this guy. That is how today's futures price is related to tomorrow's spot price or the spot price at the end of the year. Of course, because the spot price at the end of the year is uncertain. So we will just want to understand the expected futures. So we will just want to understand the expected spot price at the end of the year. Right? So now our purpose is we want to understand how these two guys are related. Right? This is actually pretty important. And if you buy financial product which invests in futures, it's very important for you to understand how futures price and the expected the expected the expected spot price are related. So we have basically four hypotheses, right, to explain how these two guys are related. So the first one is called expectation hypothesis, and the second one is normal backwardation. The third one is contango, and the fourth one is based on this modern portfolio theory. In reality, when you actually trade futures, at least from industry's perspective, these two things are pretty important. Okay, so first, the expectations hypothesis. Well, this is a very simple hypothesis. It basically means that the futures price equals the expected value of the future spot price. So basically, you're saying that let's say you have a futures, right? And it will mature, or the delivery date is at time t. Right? So this is your delivery date. And then this future has a future price of F0. And let's say the expected price is given by EPT, that is the expected spot price on this delivery date. And expectation hypothesis says that these two things should be the same, right? Clearly, this will give you this result on this expected profit. Remember that if you're taking a long position, your profit on the delivery date is given by the spot price on this delivery date minus your futures price. If you're taking a short position, your profit on the delivery date will be the negative of the profit from the long position, right? So it should be F0 minus PT. Now you can see that your expected profit would be given by EPT minus F0, and if you're in short position, it should be F0 minus EPT. Oh, I forgot to mention that E is just expectation, right? Expectation. Now, under this assumption of expectation hypothesis, you can see that this has to be 0 and this has to be 0. So it basically means that if there is a world in which the expectation hypothesis holds, then futures sellers and buyers, that's not accurate. Let me restate this. So if there's a world in which the expectations hypothesis holds, then the long position and short position in futures contract will never be able to make money, right? So everybody's profit would be just 0. That's the implication on profits under the expectation hypothesis. Okay, the second hypothesis is the normal backwardation. So normal backwardation basically says the futures price should be smaller compared with the expected spot price on the delivery date. Right? So why do we have this result? What's the assumption under this result? Well, the assumption is commodity sellers are hedgers, or you could say there are more hedgers among sellers than buyers. Okay, let me explain why under this assumption we will observe this normal backwardation. So let's say we have wheat farmers. Well, wheat farmers are definitely commodity sellers, right? Because they want to sell their wheat. And these sellers, they want to hedge against the risk of future uncertain wheat prices. And we understand if you have a long position in wheat and you want to hedge against the pricing risk, what you should do? Well, you should take a short position in futures, right? Because again, if I am the farmer, I have some wheat in my house and I want to sell it in the next year, I could enter the short futures position, let's say at a future price of 100 per ton. Then this means that in the future, in the next year, on this delivery date, I will for sure sell my wheat at $100 per ton. Right? So the uncertainty will be completely removed because I entered into this short futures position. Now, think about this. In this case, wheat farmers, they are hedgers. That is, they don't like the risk of uncertain wheat prices, right? And these farmers, right? These farmers, they're only in a short position. However, we're talking about futures contract here. Any contract, you need two parties. So these farmers, they have to find out the counterparty or the other party who are happy to enter into this long position, right? That is these farmers, they want to find out partners who are happy to take this long position. But how these farmers can find out the other party to enter the long position? Well, the farmers have to offer them some profit, right? So the farmers will offer them some profit. How can the farmers offer some profit? Well, they will reduce this futures price, right? Because you can see that if futures price is smaller than this expected spot price, then you can see that long position will earn a profit, right? Or expected profit. Which is given by EPT minus F0, right? So this basically means that farmers will have to hedge against the risk. So they will give out this profit, right, to induce the other party to enter into this long position. So what's the implication here? Obviously, first, the implication is in normal backwardation, long position will earn a profit and short position will suffer a loss. But short position is happy to suffer a loss because we have assumed short position are hedgers. So they want to hedge against the risk. So they are willing to suffer a loss to remove this uncertainty in future prices. And the second implication, which is fairly important, is futures price will rise over the life of the contract. Why do we get this result? Well, because we know that initially, future price is, okay, what happened to my Apple Pen? So initially, future price is smaller than expected. Is smaller than this expected spot price. And then we know that on the delivery date, right, there is this convergence result. That is, on this delivery date, we will ultimately get the futures price equals the expected spot price, right? So this basically means that this FT has to be larger than F0. This basically says the futures price will increase as this futures approach maturity. So it means this. The horizontal axis is time, right? So this is the delivery date. The vertical axis is futures price. So in the beginning, at F0, we know that it has to be smaller than EPT. And we know that by this convergence property, on the delivery date, PT has to be equal to FT, right? So you can see that the futures price will increase as this futures approach delivery date. So you will get this upward sloping curve. Okay, let's look at the third theory, which is contango. Contango basically says that futures price will be larger than the expected spot price. So you can see that contango is the opposite of normal backwardation. So what's the assumption? The assumption here is commodity buyers are hedgers. So you can see that this argument is the opposite to this argument here. So you will definitely get the opposite result. Now let's see how this could lead to this contango. Well, let's say we have wheat processors. Clearly, wheat processors, they are commodity buyers, because these processors, they have to buy wheat for processing, right? So let's say these buyers, they want to hedge against the risk of uncertain wheat price. Now, how could we do this? Well, they have to take a long position, right? So again, for example, if you're the wheat process, you want to buy wheat in next year, and you don't like this uncertain prices, what you can do is you will enter the long position, and this, let's say this futures contract has a futures price of $200 per ton, right? It means that in the next year, on this delivery date, you will for sure buy this wheat at $200 per ton, right? So what's the implication here? Well, I forgot to mention why do we have this result. So basically, if these processors, they're the hedgers, again, they have to find out the other party. who is happy to take the short position. So this basically means that these processors will have to give the short position some positive profit to induce the other party to take this short position, right? So this implies that the initial futures price has to be larger than this expected spot price. The reason is because for a short position, its profit is given by F0 minus the expected spot price. So this has to be positive. Now, what's the implication here? Again, two implications. First, in the world of contango, short position will earn a positive profit. Then long position will suffer a loss. But long position is happy to suffer a loss because by suffering a loss, they will be able to remove the uncertainty, right? Because they're hedgers. They wanted to remove the uncertainty in the future. And the second implication is future price will decrease over the life of the contract. The reason is because in the beginning, F0 larger than EPT. Again, by the convergence property. On this delivery date, we will have Ft equals Pt. So this implies that Ft is larger than F0. That is, initial futures price is larger than the futures price on this delivery date. So this implies that if there is contango, then the initial future price will decrease when the time is close to the delivery date. Okay, and where's the other? Okay, we have finished the contango. Okay, I don't think we have enough time for this example. So today, let's just stop here.